Hey guys, it is Julie here with TipRanks. Today we're taking a look at 4 strong buy energy and utility stocks. So let's get into it. Alright guys, welcome back and thank you all so much for being here. Now, like I said, we're looking at energy and utility stocks today. Many of you know energy stocks, and we also have the utility sector. Now that is an industrial category of companies that provide everyday amenities such as electricity, natural gas, and water. All of these stocks today come in with an overall strong buy consensus from Wall Street analysts with some sizable upside potential, and as a bonus, they all also pay a dividend. Of course, I am never here to tell you guys which stocks to buy or sell, simply sharing the insight of some Wall Street analysts to maybe give you some ideas to kickstart some research. But please make sure you're always doing your own research and due diligence before making any investment decision. Now let's jump right into today's stocks, starting off with EOG Resources. Their stock trades under the ticker EOG, currently priced at $114 per share with a market cap of nearly $67 billion. The stock has been up and down this past year, overall up just about 1%. EOG Resources is one of the largest crude oil and natural gas exploration and production companies in the United States. The company is focused on being among the lowest cost, highest return, and lowest emission producers, playing a significant role in the long-term future of energy. Their net proved reserves are in the US and Trinidad and Tobago, with 9 different offices throughout. At the start of May, EOG shared their Q1 earnings results, where they came out with a solid earnings beat and declared their most recent dividend. Their next quarterly dividend will be 82 cents per share for a very attractive yield of 8.1%, with an ex-dividend coming up on July 14th. Now, the company does boast 25 years of stable and growing dividends, with a dividend that has never been suspended or reduced. Looking at their Q1 results, they reported revenue of $6.04 billion, and that grew 51% year over year. They also generated $1.1 billion in free cash flow. Their earnings per share came in at $2.69, which was 20 cents ahead of analysts' expectations. And of course, following an earnings report, we have plenty of analysts reiterating their price targets. Currently, the EOG stock has 21 ratings. And that breaks down to 18 buys and just 3 holds. Their average price target comes in at $147, which would be an upside potential of over 28%. And taking a look here at the most recent ratings, we have a lot of 5-star analysts too, which is great to see. Upside potentials range from 11% all the way up to nearly 50%. Up next, we have Crescent Point Energy. Trading under the ticker CPG, this stock is priced at just $6.79 per share, and they are down slightly over this past year at 7.81%. Crescent Point Energy is a North American oil producer based out of Canada. Founded back in 2001, the company focused primarily on light oil production in southern Saskatchewan and central Alberta. They have an average annual production of 160 to 166,000 barrels of oil equivalent per day. Now, it is worth noting that they are facing some temporary headwinds up in Alberta due to some wildfires that have caused them to temporarily shut down some of their plants. So hopefully that doesn't continue much longer and have any impact on overall production. They just reported their latest earnings report last Friday on May 12th, along with declaring their most recent dividend. That next dividend is 10 cents Canadian per share, or about 7 cents in the US, and that'll be an ex-dividend date of June 15th. That gives them a current yield of about 4.3%. For their Q1, they reported earnings per share of 30 cents US, which was pretty much in line with expectations depending what analysts you were looking at, as well as revenues of 913.6 million Canadian. The CPG stock has 9 current analyst ratings, and they all come in with unanimous buys. With an average price target of $10.68, that would imply an upside potential of nearly 58% from current prices. Taking a look at our detailed list, the most recent rating came last week following that earnings from RBC with an upside of 43%. The rest are a bit more dated from last month and a couple months ago, ranging from 42 all the way up to 98% upside. Third up, we're going to take a look at ARIS Water Solutions. Trading under the ticker ARIS, this stock is currently priced at $9.42, and they have had a tough year. Falling from a 52-week high of $23, they are down 45%, but they have recently seen a bounce back up, so maybe the stock finally found its bottom. ARIS Water Solutions is a leader in developing and operating water infrastructure assets and recycling. They construct and operate integrated produced water infrastructure systems that provide high-capacity gathering, transportation, disposal, recycling, and brackish water supply solutions to oil and gas producers across the Permian Basin. Their growing footprint allows them to aggregate large volumes of produced water from multiple operators to reliably and responsibly treat and redeliver recycled volumes back to their customers. As you may have guessed, the company also recently shared their latest earnings report, and that earnings beat is the reason behind the stock's recent growth. They reported earnings per share of 11 cents, which came in 3 cents ahead of analyst expectations, and revenue of $91.6 million grew 29% year-over-year, coming in $10.5 million ahead of estimates. The company also reaffirmed their full-year outlook and also declared their 9-cent quarterly dividend for a current dividend yield of 4.04%. That ex-dividend date will come up on June 15th. The ARIS Water Solutions stock currently has 9 analyst ratings, coming in as a strong buy based on 7 buy ratings and 2 holds. Their average price target of over $14 would be an upside potential of over 53%. The most recent ratings coming in just a couple days ago, we do have those couple holds, one with a downside of a few percent, but some recent buys as well with some pretty attractive double-digit upside. And last but certainly not least, we're taking a look at Vistra Energy. Their stock trades under the ticker VST, currently priced at $24.58 per share. And you can see they've had quite the volatile year, with some dramatic moves up and down. The most recent coming here in March, of course, following an earnings report. Vistra is an energy company engaging in the provision of electricity and power generation. Vistra is one of the largest competitive electricity providers in the country and offers over 50 renewable energy plants. The company is also the largest competitive power generator in the U.S. with a capacity of approximately 37,000 megawatts powered by a diverse portfolio, including natural gas, nuclear, solar, and battery energy storage facilities. They're also a large purchaser of wind power. Back in March, the company did announce their full-year earnings, but also an acquisition. They announced they'd be creating Vistra Vision, which would be a leading zero-carbon generation and retail platform through the acquisition of Energy Harbor. This would combine Energy Harbor's nuclear and retail businesses with Vistra's nuclear and retail businesses and their renewable and storage products under a newly formed subsidiary holding company. On May 9th, we heard the company's Q1 earnings results, where they recorded first quarter net income of $698 million and reaffirmed their ongoing operations adjusted EBITDA guidance ranges. Their next quarterly dividend will be 20 cents per share for a dividend yield of 3.05% and an ex-dividend date of June 20th. While the Vistra stock does just have 5 current analyst ratings, all of those come in as unanimous buys. With an average price target of $35 per share, that would be an upside potential of 43% from current prices. Looking at the most recent ratings coming in the last few weeks, they range from an upside of 22% all the way up to 50%. So there we have 4 stocks in the utility sector that analysts rate a strong buy with some pretty attractive upside potential. Of course, some of these definitely looking a bit riskier than other stocks, and that's to each their own. With some of that risk can come more reward, but make sure you're always understanding your own risk tolerance and investing accordingly. With big upside can come big downside as well, so just plan accordingly. If you made it to the end of today's video, don't forget to hit that thumbs up button and make sure you subscribe to the channel as well. Thank you guys so much for watching. Have a great day, and I'll see you back here next time.